again, if you're a client or somebody investing, this is the stuff that you can't predict. And so even more to the market timing thing. If you're an economic expert, you know exactly how markets work and you know exactly how math works. You cannot predict how governments will act. Anything else? Predictions?
Oh, these are dangerous.
Uh-oh.
I'll put that on David.
We actually were decent last time. We'll go with David first. I'll tell you what last times were. Jason said maybe one rate hike, steady housing market, tech correction, which, by the way, since our last one, we've had some. We just recently sort of came out of a pretty significant down period in the market. Kyle, no recession coming. Haven't had that. I said rate hikes will lead to a down market in the back half of the year. We've sort of seen that, but again, just pulled out of it recently. And I think that was part of what David was talking about earlier, that the market's always pricing in, oh, well, we're going to have 4 rate cuts next year. If we don't have any rate cuts next year, that could change. And then Chris said value over growth, slightly lower 30-year mortgage rates. Did we get that, Chris?
No, we didn't. Well, if we would have waited maybe another 2 weeks, we might be able to get
unsuccessful.
Hey, it came out lower than it was a few weeks ago, but not lower from our last prediction. It went higher, now it's coming down.
It's all about timing, right? Bad timing. We should have the roundtable a little bit later.
True.
David, you want to start because you're smarter than all of us.
Sure. So I think that there's one more rate hike coming from the Fed. Maybe not in December. Maybe it comes in January of next year, but I get the sense, having listened to Powell over the past couple of weeks, first it was, well, rates are up, equities are down, the market's doing our job for us in terms of tightening financial conditions. And now that whole thing is completely reversed. And so I think the Fed is probably a little bit uneasy here. And again, the biggest mistake they could make is stopping the tightening process too soon and then have to re-engage at some point down the road, because that'll just mean more economic pain. So I think the Fed errs on the side of caution, and we get one more rate hike before they go on an extended pause.
And what do you think that does to the market? Does that completely transform their view of 24, or is it just like, oh, okay, we had one more, and then but we're eventually going to start moving down?
So I think it probably will weigh on longer term yields, because the market will begin to get concerned that the Fed is overdoing it and that growth will slow more significantly than currently seems to be in the price. And I think, equities will bounce around a little bit if they do one more. But let's not forget, I mean, there's one more hike in their forecasts as of September. And so it's information that they've put out there. The question is whether or not it's been fully digested. So a little bit more volatility, but probably lower rates at the end of the day, which is good for asset prices overall.
Jason?
Oh, predictions, man. This has been incredibly difficult. This year, in my career, I mean, we've all been doing this a similar amount of time, going back a couple of decades now. But what's so different this year is just the divergence of investments. Usually we use that metaphor of all boats in the same harbor. Stocks are up, stocks are down. They generally move together. But what a divergence this year when you look at like large cap, large company tech stocks, the names we are all familiar with, and then you compare that to smaller companies, smaller and middle-sized companies. The Russell 2000 is an index, and they couldn't be moving further apart. Oil and water. And so it wouldn't surprise me if the rates stay a little bit higher for longer, which I think that's going to put pressure on these, in my opinion, slightly overpriced tech stocks. I think they could come out of the clouds. It wouldn't surprise me if, I know we are all moving towards AI eventually, but the speed of it might not quite be as fast. I don't think all of our clients are going to be using ChatGPT 4 and 5, immediately. So I think things may slow down a little bit. I think bonds are a great spot to be, because I agree with David that I don't think rates are going to be dropping down tremendously fast, but I don't think they're going to be going much higher either. So it's nice now to be in bonds, clipping a coupon somewhere between 4 and 6%, depending upon the bond fund. So I think bonds are going to be a good spot to be over the next 6 months, and it wouldn't surprise me if tech comes out of the clouds.
Well, I was kind of hinting on what I was going to say. I think that Chris talked about value coming back into play, and I think that regardless the recession hits in 2024 or 2025, I think that value is going to kind of start coming back into play. People are going to be looking for that a little bit more stability and that cash flow on there. So I think value will have a don't want to say better run than growth because growth is red hot, but I do think growth is going to come down and we're going to start getting some positive returns a little bit higher here in the value side. And then too, like I agree with the fixed income. I think bottom line is that if we can get 4 to 6%, and I think most of the downside that I would expect to see in the fixed income market, we've already experienced, regardless if there is another rate hike, 1 or 2 more. I think that's kind of priced in at this point. So I'm hopeful and optimistic that we'll actually see some principal appreciation in the bond market as well as the higher coupons. So I think that's finally something that we'll see here in 2024.
Real quick, Kyle, you mentioned the R word again, right? Like it's so consuming for us. It's so consuming because the media drives the conversation. So then the clients have concerns, rightfully so. But, even as David was mentioning, we may not even see some until 2025 now. Turns out then, recessions fall into our laps about every 5 to 8 years. And so we're going to talk and talk and talk and talk. And it might have just being normal where we end up seeing one every so often, but we just never stop talking about them.
Well, that goes back to our market timing and that we talked about, right? I mean, if we thought, for the last year and a half, they talked about recessions and we should have got out of the market because the recession's coming. And here we are today.
David, I don't know where JP Morgan was, but 12 months ago, right? 2023 was the most predicted anticipated recession that never happened. And I'm sure JP Morgan was in the camp too, where everyone was calling for a recession first quarter of 2023. Do you recall how that, because I'm sure everyone's backpedaled on that statement.
Yeah, no, I mean, it was very consensus to be expecting a recession. I think where everybody got it wrong is that we all should have gone totally pro risk when the Fed injected $500 billion of liquidity into the system to address what was going on with the banks, right? When rates fall by 50 bips and the Fed adds liquidity, like we've baked those cupcakes before. We know exactly what happens. And to my mind, that was just something we talk about this, like we all missed it because we were so consumed, to your point, in this idea that, there's inflation and an aggressive Fed and the economy is going to have to crack. Well, the Fed kind of rode to the rescue somewhat indirectly. And I think that's a lot of what gave this expansion additional legs.
And that's what's kind of funny is that, so you're a strategist. And now instead of talking about, again, this is back to that Econ 101 thing, instead of talking about things that actually drive the market from an economic standpoint, it's these artificial things. We miss the opportunity because the Fed put money into the system. Again, if you're a client or somebody investing, this is the stuff that you can't predict. And so even more to the market timing thing, if you're an economic expert, you know exactly how markets work and you know exactly how math works. You cannot predict how governments will act. And the Fed is part of, Federal Reserve is part of that arm. So, David just mentioned, hey, we missed the opportunity because, they injected liquidity and then prices go up. Well, that's not really something you learn in economic class. Chris?
Yeah.
I'm with Kyle. I mean, I think value over growth is probably still a theme going forward. I think, clients hear it, want it, in terms of having a dividend, having cash flow come in too. And that tends to, lend itself to value style investing, even though, as David said earlier, you can be a value investor when certain growth stocks, fall out of favor. And that's happening. I would guess there's probably a couple of really big names today in the market that are down considerably that probably just fall into a value screen like immediately because they've gotten a lot cheaper as far as the stock price goes, and it's still a great business. So that's really opportunistic value buying is probably the name of the game. But
that cuts both ways too, because you have a lot of these growth stocks that start paying dividends, and it doesn't make them value stocks.
That's right. But yeah, I think we're definitely going to have lower mortgage rates in the future. Also, I think if you look at where we are today, even versus a couple of weeks ago, I mean, it's really come off of a high, and I don't know that's going to spur a ton of real estate activity, but most of those are hinged to roughly to the 10-year Treasury. And the 10-year Treasury, if like David said earlier, the top is in for the 10-year Treasury, that means we're probably going to have lower 30-year mortgage rates. So
I think though, Chris, clients ought to be aware though. I would say that the days of 2.75% mortgages and 3.25% mortgages, those may be gone for life. And so, but 5.5, might be in the cards. And so keep that in mind if you're looking to buy real estate. I wouldn't sit on the sidelines and wait for those threes. You may not see them, but I do agree that the rates ought to come down. I forget the article I read, but normally 30-year mortgages, because they're kind of pegged to the 10-year, there's usually a spread that holds them pretty true. But the spreads widen right now, where mortgages were close to 8 when the 10-year Treasury was at around 4.5 to 5, and that spread is larger than it has been in the past, probably because of the fear that the banks have. But that difference between the two should close, which would bring mortgages down.
Well, it's like anything. It's not a single factor. If you want 2.5% 30-year mortgages, you have to do a massive amount of damage so that the Fed has to come in and go back to 0% interest rates. You don't want that. You want things to slowly go in whichever direction. And having 2.5% 30-year mortgage rates is not something. I don't want everything that comes with that to get back to
right.
That point.
Correct.
Yep. So yeah, the only thing I'll add is after listening to David and all this stuff, I'm not sure we'll get any rate cuts in 24. If again the economy is doing better than expected, again they want to keep rates up. They want to continue to bring inflation down, and if we do have a sort of a soft landing, or at least it gets delayed into 25, we may not see any rate cuts, which isn't a terrible thing. I mean, it's not going to give any extra juice to bonds, but it means the economy is doing well. It means there are fixed income investors, which is a lot of our clients because they're older and they have balanced portfolios, are going to earn a good return on fixed income going forward. So there's definitely a silver lining to that. So that's mine. I think there's going to be no rate cuts. And again, this can change like the wind, right? But no rate cuts in 24. We'll see.
Adam, one thing on that. That's another thing we mention it on most podcasts. If we don't have rate cuts, this is another reminder for people to go take a look at their cash. Wherever you keep your cash at, you shouldn't be earning 0 on it. Unless it's in your short-term checking, you should be earning more than 0%. So regardless of whether you want to have us help you with it or you do your own homework, look into that.
Money market rates are at 5. Not that they'll stay there, but they're directly tied to the Fed funds rate. So if we have, again, listen to David today and all the things that we brought up, if rates are not going to be aggressively cut, money market rates are going to stay high. If you're keeping it in your checking account, I guarantee that you're earning probably less than 1%. I think in my checking account, it's 0.000 something. I looked at it the other day. It was very, very low. So that's it. Good opportunity. Hey, this is the first time we've had a guest. David was excellent. Hopefully you gleaned some good insights from what he said. I know we did, and it helps us sort of decipher, where we may be going in the future, which is always the important part.